National Housing Board was established, which was whose primary objective was to fund housing projects. Then NABARD stands for National Bank for Agriculture and Rural Development. NABARD was established for supporting agricultural activities. SIDBI, Small Industries Development Bank of India, that was also established in order to provide financial assistance to small-scale Indian industries. So there were a number of benefits of nationalization. So increased efficiency in the industry, empowered small-scale industries was one benefit. Then, this nationalization increased public deposits because people's confidence in these banks increased. Earlier, when they used to, store money in their kitchen or with the local money lenders, now they started depositing money in the bank. Better outreach was possible through nationalization, and nationalization provided employment opportunities to a lot of bankers. After the government took over, they opened a number of branches. People started using banks more extensively. So they needed more people and thus provided greater employment opportunities. Now coming to phase 3 of the banking system. Phase 3 is from 1991 to till date. That is known as the phase 3. And since that time, since 1991 till today, the Indian banking system has been continuously evolving. During this time, the Indian government has also encouraged foreign investment. That means it opened the economy to foreign and private investors, which led to starting of a lot of foreign banks in India. Like, HSBC started during this time, Citibank, Bank of America, Standard Chartered Bank, all these banks were started in India. Apart from this, in order to stabilize the nationalized public sector banks, the Indian government also formed a nursing home committee in 1991 in order to manage the reforms in the banking sector. So, apart from this, there were some other, noteworthy developments that took place during this time. Like small finance banks, they became eligible to open branches anywhere in India. And after this, the government and both RBI, they began to treat both private and public sector banks equally, which earlier was not there. And banks also, they started digitizing their transactions. That means automation. Banks started moving towards automation. So these were some of the developments, right? Now, so there were different types of banks even at that point of time. So what are the different types of banks in India? Commercial banks, small finance banks, cooperative banks, and payments banks. Okay. So what are commercial banks? Commercial banks are those banks which adapt to the provisions of the Banking Regulations Act 1949. So these commercial banks, what they do is they accept deposits from the public and give out loans to generate profits. Commercial banks could be of 4 different types. The private sector banks, public sector banks, regional rural banks, and foreign banks. These are all commercial banks only. Now coming to small finance banks, what are small finance banks? Small finance banks are those banks that provide financial assistance to very small segments of the society that other banks do not usually serve, like small business unit, micro industries, such kind of things. Then cooperative banks, their primary motive is not to make profit, and the customers of these banks are the owners themselves, right? So there is a managing committee which controls the operations of these banks, and it is the customers of the bank who are the members of the managing committee. Okay. Then coming to the structure of the banking system in India. See, the banking system of India consists of RBI, commercial banks, cooperative banks, and development banks. Now, what all these institutions do is they provide a meeting ground for a general public, savers, people who save, investors, and they form the core of the India's financial sector. So banks play a very important role in the development process of many underdeveloped countries, right? So now again, there is another classification in banks known as the scheduled banks and non-scheduled banks. So those banks whose names are mentioned in the second schedule, they are known as scheduled banks, and all those banks whose name is not mentioned in the second schedule, they are known as non-scheduled banks. So there is something called as RBI Act 1934. There are various schedules in that. So all those banks which are included in the second schedule, they are known as scheduled banks. So what are the facilities that a scheduled bank enjoys? Scheduled bank is eligible for any debt or loan from RBI, the bank rate itself. And these scheduled banks, they automatically acquire the membership of a clearing house, which is not there for a non-scheduled bank. So these non-scheduled banks, they cannot borrow from RBI for their normal banking purposes. They can only borrow when there is some emergency. Right? Now coming to commercial banks also. Commercial banks also are of different types. Public sector bank, right? So public sector bank is one where the majority stake is held by the government. That is a public sector bank. Private sector bank, where the major stakes in the equity are owned by private stakeholders. Like ICICI Bank is a private sector bank. HDFC Bank is a private sector bank. Okay. So these are private sector banks. Coming to foreign bank. What is a foreign bank? A foreign bank is a bank that has its headquarters outside our country, outside India. So then it will be called as a foreign bank. It has its headquarters in some other country, but it runs its offices in our country, right? So that kind of banks are known as foreign banks. Now, even these foreign banks, they are under the obligation to operate under the regulations provided by the central bank of the country. So Citibank is an example of foreign bank. Bank of America is an example of foreign bank. Okay.
Page number, ma'am.
Hello. Yes. What do you want?
Page number.
I told you, no, we don't have the book with us. So I don't know the page numbers. I only know the unit numbers.
Unit number.
Which unit, ma'am?
You are not there from the beginning of the class? Unit 6, 7, and 8, I am doing in today's class. Okay? Have you heard is my voice audible? Have you heard?
Yes, ma'am.
Yes, ma'am.
Okay. 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 So that is a foreign bank. Like Bank of America is a foreign bank. Citibank is a foreign bank. Then there are some banks called as the regional rural banks. Right? So the regional rural banks are those banks which are established under the Regional Rural Banks Ordinance 1975. And the primary aim of these banks is to ensure that sufficient institutional credit is provided for agriculture and other rural areas. Right? So these regional rural banks, they are owned jointly by the government of India, the state government, and also the local sponsor bank. Okay. Coming to cooperative bank. So I told you cooperative bank is a bank which is owned by the customers themselves. So it is a financial entity that belongs to its members who are its owners as well as its customers. Right? And this cooperative banks, they provide their members with a lot of banking and financial services. Cooperative banks, they are the primary supporters of agricultural activities, small-scale industries, and also for self-employed workers. Right? Even cooperative banks can be in urban cooperative bank or rural cooperative bank also. And then there is something called as development banks. So what are development banks? Development banks are those financial institutions that provide long-term credit. They provide long-term credit to companies, to businesses For any capital intensive investments, right? If there is a company that wants to buy huge machinery, lot of infrastructure they want to develop, right? So development banks help them. So they provide them support for capital intensive investments that are spread over a long period and yield a very low rate of return. But the reason development banks support them is because of the social benefits that they give. So if there is a big factory that is set up in some area, lot of people would get employment in and around that area. So that is the benefit. Okay. So what is the meaning of a commercial bank? A commercial bank is any financial institution that performs the functions of accepting deposits from the general public and giving loans for investment with the aim of earning profit. Right? So commercial banks, as their name suggests, they are profit maximizing institutions. That means they are doing banking business in order to earn profit. Right? So they usually finance trade and commerce with short-term loans. They charge a higher rate of interest from the borrower than the rate of interest that they pay to the depositors, right? So all these banks that we see today, they are all commercial banks. So what is the significance of these commercial banks? These commercial banks, they promote savings among the general public, and thus they accelerate or they speeden up the rate of capital formation. Okay, and these commercial banks, they are the source of finance and credit for trade and industry in a particular area. Apart from this, commercial banks also promote balanced regional development by opening branches in many backward areas also. And see, bank credit is of great help to the entrepreneurs. Bank credit allows entrepreneurs to innovate and also to invest, which in fact, speeds up the process of economic development. Apart from this, what commercial banks do is they also help in promoting large-scale production and growth of priority sectors such as agriculture, small-scale industry, retail trade, export. Growth of all these sectors is possible, right? And commercial banks also create credit in the sense that they are able to give more loans and advances than the cash position of the depositor. More than what they have, they're able to give loans and advances, right? Thus, we can say that commercial banks make optimum utilization of resources. So, if you say what are the functions of of a commercial bank, we can say that the two most distinctive functions of commercial banks are borrowing and lending. Borrowing and lending. So first is accepting of deposits, right? And then lending of money to projects, to business houses or to individuals so that they earn interest. Okay. So we can say that, banks borrow in order to lend, right? So the rate of interest that is offered by the banks to the depositors is called the borrowing rate, and the rate at which the banks lend out is called as the lending rate. So the difference between these two rates is called as the spread, right? So for example, when I am deposited money in the bank will give me 8% rate of interest. But when I want to borrow from the bank, will the bank only charge 8% interest from me? No, it might charge 12%, 14%, whatever it is. So there is always the difference between the borrowing rate and the lending rate. If the difference was not there, it is not possible for banks to conduct business. That is their income, right? So that difference is known as the spread. Okay. So these two functions of banks, that is borrowing and lending, these are called as primary functions. And the remaining, the other set of functions are known as secondary functions. Primary function was accepting money, then lending. Secondary functions are, discounting of bills of exchange, providing overdraft facility to business houses, transfer of funds, collection of funds, performing the agency functions. These are all secondary functions of a bank. Okay. Now let us try to understand what is RBI. Okay. RBI is a central bank in India, right? So every nation, every country has a central bank. So in India, RBI or the Reserve Bank of India is the central bank. In US, you call it as Federal Reserve, right? So what exactly is the role of a central bank? So a central bank is a financial institution that has sole control over the generation and distribution of money and credit in a particular country, right? So it is the responsibility of the central bank to establish the monetary policy and to regulate the member banks in a country, right? And see, I told you commercial banks, the primary objective of commercial bank is to make money, is to make profit. But central banks are not competitive because these central banks are supported and funded by the government. So their job is not to make profits. So the RBI in India, the Reserve Bank of India, this was established in India in the year 1935 in accordance with the Reserve Bank of India Act 1934. Okay. So how does this RBI function? What is the composition of RBI? RBI is controlled by a central board of directors. Now, these directors, they are appointed for a 4-year term by the Government of India. Government of India appoints these directors and the rules pertaining to the appointment of these directors, it is governed by the Reserve Bank of India Act. Okay. So this central board, it consists of governor, 4 deputy governors, 2 finance ministry representatives, and 4 directors who represent the local headquarters at Mumbai, Kolkata, Chennai, and Delhi. Right? So who is the executive head of RBI? Governor is the executive head of RBI. So the current governor of RBI is Shaktikanta Das. Okay. So let us look at some of the important functions of RBI. So the first important function of RBI is issuing of currency, issuing of bank notes. So the most important function of RBI is the issuing of currency notes and coins. In India, except the 1 rupee note. The 1 rupee note is not issued by RBI, but it is issued by the Ministry of Finance. So all the other notes that you see, they all bear the signature of the RBI governor. So that is the first function of RBI, issuing of banknotes. The second function of RBI is acting as a banker to the government. So another chief function of RBI is it takes care of the banking needs of the government. What are the banking needs of the government? The government also, like any individual or a business house, they also need to maintain and operate an account, right? So these are the banking needs of the government. RBI takes care of all those, like maintaining and operating the deposit accounts of the government, collecting the receipts of funds, making payments on behalf of Government of India. All these functions are taken care of by RBI. And it also and the IMF, that is International Monetary Fund, and the World Bank, RBI represents the Indian government. Okay. Apart from this, RBI is the custodian of cash reserves of all the commercial banks. See, all the commercial banks, they are required to maintain cash reserves at a certain rate that is decided by RBI in its monetary policy. So, where do they maintain these cash reserves? They maintain these cash reserves with the RBI. Okay. And another important feature of RBI is it maintains a reserve of foreign currencies. It is a custodian of foreign exchange reserve. So that, RBI can deal with any kind of crisis situation. Okay. And another function that is played by RBI is called as the lender of the last resort. Lender of the last resort. So, or it is also known as the banker of banks. Banker of banks. So, RBI acts as a parent to all the commercial banks in India. It helps them by lending money, and in case of any financial difficulties, RBI does all that. Okay. So the next function of RBI is the controller of credit, right? So the credit that is created by commercial banks in India is controlled by the RBI, right? So RBI uses both quantitative as well as qualitative methods in order to control and regulate the flow of money in the market. And how is that implemented? That is implemented by announcing monetary policy. Monetary policy is announced in regular intervals. Okay. What is monetary policy? We'll see. We'll discuss that also later. So let us try to understand a few policies of RBI. The first policy is the repo rate. Repo rate stands for repurchase rate. What is repo rate or what is repurchase rate? It is the benchmark interest rate at which RBI lends money to all the other banks for a short term. So what happens when there is a change in this repo rate? When the repo rate increases, borrowing from RBI becomes more expensive. And thus the customers or the general public, they have to face the outcome of the high interest rate. Okay. Next, there is something called as reverse repo rate. So what is reverse repo rate? Reverse repo rate is a short-term borrowing rate at which RBI borrows money from other banks, right? Why does RBI borrow money from other banks? RBI uses this method in order to reduce inflation. Okay, in order to reduce inflation when there is excess money in the banking system. Then third one, cash reserve ratio. What is cash reserve ratio? Cash reserve ratio is the particular share of any bank's total deposit that is mandatory and that has to be maintained with the RBI in the form of liquid cash. So RBI can bring about changes in this as well. Cash reserve ratio also could be changed. Now, apart from this cash, liquid cash, banks also have to maintain liquid assets like gold or approved securities with the Reserve Bank of India. Some portion has to be maintained in the form of gold or other approved securities. So this is known as liquidity statutory ratio, SLR. It is known as SLR, liquidity statutory liquidity ratio. When the SLR is higher, what happens is the higher SLR, it disables the banks to grant more loans. It is not possible for banks to grant more loans, right? Okay. So that was about RBI and functions of RBI. Now let us try to understand monetary policy. What is monetary policy? See, monetary policy refers is not just like one activity or one intervention. It refers to an umbrella of operations that are used for control of money supply in the economy. Okay, all those operations, all those activities that are used to control money supply in an economy, they are known as monetary policy. And what is the broad objective of monetary policy? The broad objective of monetary policy is to maintain economic and financial stability. Okay, economic and financial stability. And monetary policy also makes sure that adequate financial resources are available for developmental purposes. These are like the primary objectives of monetary policy in India. But over a period of time, there is a gradual evaluation, and now monetary policy also tries to take care of other things like maintaining price stability, maintaining adequate flow of credit to some specified sectors, then promotion of productive investments, trade, promotion of exports, economic growth. Right? These are some of the objectives. So if we try to understand some of the objectives of monetary policy, there are four main objectives. Okay, four important objectives: full employment, price stability, economic growth, and balance of payments. So coming to the first one, full employment has been ranked among the foremost objectives of monetary policy. It is an important goal not only because unemployment leads to a lot of wastage of resources, but also because of the loss of social standing and self-respect. Okay, so that is why it is so very important. Next, coming to price stability. So one of the policy objectives of monetary policy is to stabilize the price level. Okay, so see, both economists as well as general public, they both favor this policy of price stability because fluctuations in prices, they are not good for anybody, not for individuals, not for business houses, or not for the economy as a whole. So these fluctuations in prices, what they do is they bring about uncertainty and instability in the economy. Okay. The third one is economic growth. So one of the most important objectives of monetary policy in the recent years, it has been rapid economic growth of an economy. Okay. So what is economic growth? Economic growth is a process wherein the real per capita income of a country increases over a long period of time. And another objective of monetary policy is also to maintain the equilibrium in the balance of payment. Okay. So coming now, next we will try to understand what are the instruments of monetary policy. That is, how does see, we talked about all these different objectives of monetary policy, but how does monetary policy achieve these objectives? So there are two main instruments of the monetary policy that can be used to achieve all these objectives that we discussed just now. What are those instruments? Quantitative instruments and qualitative instruments. Okay, so quantitative instruments are also known as general tools. Quantitative instruments are also known as the general tools of monetary policy. Okay, so these tools, they are more concerned with the quantity of money or volume of the money. So these tools, these tools are designed in order to regulate or control the total volume of bank credit in the economy. The total volume of bank credit in the economy, that can be controlled. So these tools, they are indirect in nature, and they are primarily employed for influencing the quantity of credit in the economy, how much of credit is available to the general public or to the business houses, or in general, what is the total amount, quantum of credit that is available. So the first one is known as the bank rate policy. Okay. So the bank rate policy, it is a very important technique that is used in the monetary policy for influencing the volume or quantity of credit in a country. So this bank rate, it refers to that rate at which the central bank, it rediscounts bills and prepares commercial banks, or it provides advances to the commercial banks. So bank rate is nothing but the standard rate at which a bank is prepared to buy or rediscount bills of exchange or any other commercial paper that is eligible for purchase. Right? So any change in the bank rate, it is normally associated with the resulting change in the lending rate and in the market rate of interest. Okay. But the efficiency of the bank rate as a tool of monetary policy, that depends on the existing banking network. Right? So that is the bank rate policy. Next tool is known as the open market operation. Open market operation. So this open market operation, it refers to the purchase and sale of short-term and long-term securities by the RBI in the open market. So this is a very effective and popular instrument of the monetary policy, right? So this open market operation, that can be used to wipe out a shortage of money in the money market. It can be used to influence the term and structure of the interest rate, and it can be used to stabilize the market for government securities. If the RBI, it sells a security in the open market, commercial banks and private individuals buy those securities. So what happens when they buy those securities? The existing money supply is reduced, right? The existing money supply is reduced, and where does this money go? Where does this money get transferred from? This money gets transferred from commercial banks to the RBI. Okay. Contrary to this, when the RBI buys the securities from the commercial bank, right? So commercial banks sell it and they get back the money that they had invested in them. So obviously, what is happening? The stock of the money in the economy is increasing. So this way, when the RBI enters the open market operation transactions, the actual stock of money available in an economy gets changed. Okay. And then the third tool or third technique is variation in the reserve ratio. So commercial banks, they have to keep a certain proportion of their total assets in the form of cash reserve. Right? So some of these cash reserves are their total assets in the form of cash. So apart from these cash reserves, they are to be kept with the RBI for the purpose of maintaining liquidity and controlling credit in an economy. We discussed just now, no? CRR, cash reserve ratio, SLR, statutory liquidity ratio. They all play this role, right? So CRR, what is CRR? CRR refers to some percentage of commercial banks' net demand and time liabilities, which that commercial bank has to maintain with the RBI. And SLR is some percentage of the reserve that has to be maintained in the form of gold or foreign securities. Right? So any change in these reserve ratios, that is CRR or SLR, any change in these, they bring out a change in the commercial bank's reserves positions. So by changing VRR, what RBI can do is, RBI can change the lending capacity of banks. Okay. So changes in this reserve ratios, they help in bringing about changes in the cash reserves of commercial banks, and it can also affect the bank's credit creation multiplier. Right? So that is the variation in the reserve ratio. So what all instruments or tools that we discussed so far, there was the quantitative instrument, because they dealt with the amount, quantity of money. Next, coming to qualitative instruments. So qualitative instruments are also known as the selective tools. They were called as general tools. These are called as selective tools of monetary policy. So these tools are not directed towards the quality of credit or the use of credit. They are used for discriminating between different uses of credit. So it can be discrimination favoring export over import or essential over non-essential credit supply. But this method, they can have an influence over the lender and the borrower credit. So let us look at some of the qualitative instruments. The first one is fixing margin requirements. So what is margin? Margin refers to the proportion of loan amount which is not financed by the bank. For example, I want to buy a house for 10 lakh rupees. So when I go to a bank and approach for loan, the bank would not give me entire 10 lakh rupees to buy the house. The bank would say, we will only give you 8 lakhs or 7 lakhs. The remaining amount I have to pull in from my personal sources. So that remaining amount that the bank will not give me as loan, that is known as the margin. Right? So margin is that part of a loan which a borrower has to raise in order to get finance from the bank. Now, a change in this margin, it implies that there is a change in the loan size. So, for example, if the margin is only 1 lakh, then I can get 9 lakhs loan from the bank. Whereas if the margin is 4 lakhs, I will get only 6 lakhs loan from the bank. So, this method is used to encourage credit supply for the needy sector and discourage it for the non-necessary sector. That means, see, if the RBI feels that more loans should be given to agricultural sector, so what they might say, they might reduce the margin there. So they might say, okay, margin is only 10%. But if RBI, and similarly RBI feels less credit should be given to vehicle finance. So they might say, see, if you want to buy a car, the margin will not be 10%, the margin might be 40% or something like that. So they will decide which sectors are more important and which sectors are less important. And the next tool is consumer credit regulation. Consumer credit regulation. So under this method, what happens is consumer credit supply that is regulated through hire purchase, that is regulated through installment sale of consumer goods. So under this method, the down payment, installment amount, the loan duration, all of that is fixed in advance. Okay, so this method can also help in checking the credit use and inflation in a country. Publicity. Okay, publicity is also another method of selective credit control. So what RBI does is RBI publishes various reports wherein it states what is good and what is bad in the system. So this published information, it can help the commercial banks to direct supply in the desired sectors. So, RBI comes up with weekly bulletins, monthly bulletins, and this information is made public so that banks can use it for attaining the goals of the monetary policy. So that is publicity. The next one is credit rationing. What is credit rationing? So what RBI does is it fixes the credit amount to be granted. Right? What is the credit amount to be granted? That is fixed. So credit is rationed by limiting the amount that is available for each commercial bank. This method controls even bill rediscounting also. So for some purposes, the upper limit of credit can be fixed and the banks might be told to stick to that limit only. What this will do is, it will help in lowering the bank's credit exposure to unwanted sectors. What are unwanted sectors? Unwanted sectors are those sectors which will not be very useful for the economy. So those sectors are known as unwanted sectors. Next one is moral suasion. So moral suasion implies to the pressure that is exerted by the RBI on the Indian banking system without any strict action for compliance of the rules. So that means even RBI will not take any action. It is just a suggestion to banks, right? It is just a suggestion. So what moral suasion does is it helps in restraining credit during inflationary periods. So commercial banks at regular intervals they are informed about the expectations of the central bank through a monetary policy. So central banks can issue directives, guidelines, and suggestions for commercial banks, reducing reducing credit supply for example, speculative purposes, so that they can do. I want to do stock trading, right? So I might not, whereas somebody wants to invest in agriculture. So that person who wants to invest in agriculture should be given preference to a person who wants to do trading in stocks. Then control through directives. So under this method, what the central bank does is the central bank issues a frequent directives to commercial banks. So these directives guide commercial banks in framing their lending policy. Whatever is the lending policy that the commercial bank wants to have, these directives would guide them. Okay, then the direct action. See, under this method, the RBI can impose an action against a bank. For example, if certain banks are not adhering to the RBI's directives, the RBI may refuse to rediscount their bills and securities. And secondly, RBI may refuse credit supply to those banks whose borrowings are in excess of their capital. RBI can also penalize a bank by changing some rates. Okay, so yeah, in fact, if it comes to that worst situation, RBI can also put a ban on a particular bank if that bank is not following its directives and if that bank is working against the objectives of the monetary policy. Right? Then the last topic that we need to discuss is what is credit control. Okay, so credit control is also similar to what we discussed so far. How much of credit is available in the market? How much of credit is available to business houses? That is maintaining that is known as credit control. So what is credit control? Credit control is a lending strategy. Okay, credit control is a lending strategy that banks and financial institutions use in order to lend money to customers. Okay, so this strategy emphasizes on lending money to those customers who have a good credit score or a good credit record. So you must have heard about CIBIL score. So CIBIL, if you have a higher CIBIL score, that means you have a good credit score. Right? So customers with a good credit report or a good credit record, they usually have an excellent track record of repaying their debt. Now, what does this allow? This allows lenders to bring down the risk of default whenever they're issuing a new line of credit to the customers. Right? So what credit control does is credit control helps banks and financial institutions to recognize those customers who have a very poor credit report and also ensure that such borrowers are not extended any credit. So what this would do is this would eventually help the lenders to minimize the customer's probability of not repaying their debt on time, and that would actually increase profitable lending. Banks would become more profitable, which is not only good for the bank, but it is also good for so many other stakeholders who are dependent on the bank. So who all use credit control? Banks use credit control. Financial institutions use credit control primarily. Sometimes retailers and manufacturers also use it. Right? So this is about credit control. This is about the three units that I told you, unit 6, 7, and 8. Banking, RBI, and monetary policy. Okay, these are the three things that we had to discuss in this class. With this, I'm ending this class. Next class we will have again on Saturday at the same time, 1:30.